If you make $75,000 a year, you pay more for car insurance than someone who makes $250,000. Not because you drive worse, not because you file more claims, because your credit score is lower. And in most states, that's all it takes. A driver with poor credit pays roughly double what a driver with excellent credit pays for the exact same coverage. That's over $1,400 more per year nationally. And in some states, the gap exceeds $4,000. Same car, same neighborhood, same driving record, different price. And auto insurance is just one line item in a much larger pattern. There is a surcharge built into American life that almost nobody talks about. It doesn't show up as a tax. It doesn't appear on a receipt, but it compounds quietly across every major spending category year after year, and it falls heaviest on the people in the middle. The households earning $50,000 to $150,000 who are doing everything they were told to do and still feel like they're falling behind. In this video, you'll see the specific categories where being middle class costs more than being rich, the structural reasons the system is designed this way, and the practical steps to reduce what I'm calling the middle class markup, the invisible premium you're paying for the privilege of not being wealthy. Let's start with the most expensive thing most people pay for after housing. Healthcare, because this is where the middle class penalty is the most brutal and the most deliberately engineered. The American healthcare system has 3 tiers. If you're low income, Medicaid covers you, often with 0 premiums and minimal copays. If you're wealthy, you self-insure, you have concierge medicine, or your employer's sponsored plan is comprehensive enough that a $7,000 deductible is an inconvenience, not a catastrophe. But if you're in the middle, earning between roughly $60,000 and $120,000 for a household, you're in what healthcare economists call the coverage gap. Here's what that looks like in 2026. Enhanced premium tax credits for Affordable Care Act marketplace plans expired at the end of 2025. KFF estimates that the average enrollee's out-of-pocket premium more than doubled, increasing by 114%. A 40-year-old individual earning $55,000 went from paying close to $0 for a silver plan to paying nearly $800 a year. And if they switch to a cheaper bronze plan to save on the premium, the average deductible jumps to $7,476. That means they're insured, but effectively paying out of pocket for everything short of a major hospitalization. Meanwhile, someone earning $250,000 with employer-sponsored coverage is paying a fraction of that in premiums, has a deductible under $2,000, and never thinks about it. The middle-class worker isn't uninsured. They're underinsured at a premium price. 1 ER visit, 1 MRI, 1 ambulance ride, and they're financing their health on a credit card at 22% interest. That's not a healthcare system. That's a wealth extraction mechanism with a copay. Now let's move to insurance more broadly, because the healthcare penalty is part of a larger pattern where the system charges you more when you have less. An NPR investigation in 2025 obtained more than 500,000 auto insurance premium estimates across nearly every zip code in the country. What they found was startling. Drivers with poor credit routinely pay double what drivers with excellent credit pay for the same coverage. In some states, the gap is even wider. In New York, a driver with poor credit pays an average of $7,590 per year for full coverage auto insurance, 88% more than the $4,031 a driver with good credit pays. Same road, same risk, same car, different price. And here's the part that makes this a structural trap rather than a fair assessment of risk. Your credit score is not a measure of how well you drive. It's a measure of how much financial margin you have. If you went through a divorce, a medical emergency, a job loss, anything that temporarily disrupted your income, your credit score dropped. And the moment it dropped, your insurance went up. You didn't become a worse driver. You became a more profitable customer. The Consumer Federation of America calls this the poverty surcharge. Drivers with lower economic status, measured by education, occupation, home ownership, and marital status, paid 40 to 92% more for basic liability insurance than drivers with higher economic status, even with identical driving records. The system is not pricing risk. It's pricing vulnerability. Let me put a number on what this costs over a working lifetime. Say you're 30 years old and your credit score puts you in the fair range instead of excellent. The auto insurance gap alone is roughly $2,000 to $4,500 per year. Your homeowner's or renter's insurance carries a similar credit-based premium. Add another $300 to $800 a year, your credit card interest rate is 24% instead of 17%. If you carry an average balance of $6,000, that's an extra $420 per year in interest on the same debt from the same bank with the same payment history. Add in the higher mortgage rate. A half-point difference on a $300,000 loan costs roughly $30,000 over the life of the mortgage. Add the overdraft fees. Americans paid $12.1 billion in overdraft and NSF fees in 2024, and research from the New York Fed shows that just 9% of households generate nearly 75% of that revenue. Add the convenience costs, higher prices at the only grocery store in your neighborhood, payday loan fees, check cashing services, and the inability to buy in bulk because you don't have the cash cushion to stock up when prices are low. Stack all of this, and the middle class markup is somewhere between $4,000 and $8,000 per year compared to a wealthy household buying the exact same life. Over 30 years, invested at a 7% average return, that gap compounds to between $380,000 and $760,000 in lost wealth, not from bad decisions, from being charged more for the same products because the pricing models are built to extract more from people with less margin. This is the paradox. The less money you have, the more expensive everything becomes. And the more expensive everything becomes, the harder it is to build the margin that would make everything cheaper. It's a loop. And it's not accidental. Now, here's what most people miss about this. The middle class experiences the worst version of this penalty, not the poor, who at least qualify for subsidized programs, income-based pricing, and safety net protections, and not the wealthy, who negotiate everything, pay in full, and access wholesale pricing on financial products. The middle class sits in the dead zone, too much income to qualify for help, too little wealth to command leverage. Think about how a wealthy household interacts with a bank. They call a relationship manager, they negotiate rates, they get fee waivers, preferential mortgage terms, and private banking services. Not because they need them more, but because they're profitable clients the bank wants to retain. Their wealth generates leverage, and that leverage reduces cost. Now think about how a middle-class household interacts with the same bank. They get the standard rate, they pay the standard fees, they accept the terms as given because they don't know the terms are negotiable, or because the bank has no incentive to negotiate with them. Their account balance doesn't move the needle. They are a revenue line, not a relationship. This extends beyond banking. Wealthy households buy in bulk, whether it's a Costco membership or buying a car in cash to avoid financing charges. They pay annually instead of monthly, which often comes with a discount, insurance, gym memberships, software subscriptions. They maintain higher deductibles because they can absorb the risk, which lowers their premiums. They time major purchases, negotiate aggressively, and have the liquidity to walk away from bad deals. Middle-class households pay monthly because they have to. They carry lower deductibles because they can't afford a $5,000 surprise, which raises their premiums. They finance everything, the car, the appliances, the phone, because they don't have the cash, which means they pay interest on top of the sticker price. They accept the first offer because they need the product now, not next month. Every single one of these behaviors is rational, given the constraints. That's the cruelest part. The middle class isn't making bad decisions. They're making the only decisions available to them, and each one costs more than the version available to someone with a larger cushion. So what do you actually do with this information? You can't change the pricing models. You can't opt out of the credit-based insurance system in 46 states, but you can systematically reduce the markup by understanding where it hides and attacking the highest cost categories first. 1. Treat your credit score as a price reduction tool, not a borrowing tool. Every 50-point improvement in your FICO score reduces your auto insurance, your homeowner's insurance, your mortgage rate, and your credit card APR simultaneously. The single highest ROI financial move for a middle-class household is not investing more. It's getting your credit score above 740. At that threshold, most pricing models move you into the lowest cost tier across every category. Pay down revolving balances below 30% utilization. Set up auto pay on every account so you never miss a due date. Dispute errors on your credit report. 1 in 5 reports contains a material error. These are boring moves. They are also worth thousands of dollars per year in reduced costs. 2. Shop insurance annually, not loyally. Insurance companies use what the industry calls a loyalty penalty. They raise your rates gradually, counting on the fact that you won't compare. NPR's investigation found that the gap between the best and worst quote for the same driver in the same zip code was often thousands of dollars. 30 minutes of comparison shopping once a year can save you $500 to $1,500. And that's a guaranteed return, not a market bet. 3. Raise your deductibles deliberately. If you have an emergency fund of $1,000 or more, moving your auto and homeowner's deductible from $500 to $1,000 or from $1,000 to $2,500 can reduce your premiums by 10 to 25%. You're self-insuring the small stuff and paying less for the catastrophic coverage you actually need. This is exactly what wealthy households do. The only difference is they do it with a $50,000 cushion. You can do it with $2,500. 4. Stop paying monthly when annual is cheaper. Audit every recurring expense, insurance, subscriptions, memberships, and check if there's an annual payment discount. Most insurance companies offer 5 to 10% off for paying the full year upfront. If cash flow doesn't allow it today, build a sinking fund. $50 a month set aside so that in 12 months you can switch to annual payment on your highest cost policy. 5. Negotiate at least one bill per month. Call your credit card company and request a rate reduction. Call your internet provider and ask about retention offers. Call your insurance company and ask if there are discounts you're not receiving. Wealthy households negotiate everything. Middle-class households accept everything. The difference is not confidence. It's the assumption that prices are fixed. They're not. They are almost never fixed. The middle-class markup is not a conspiracy. It's a pricing architecture. Insurance companies use credit because it predicts profitability. Banks charge fees because accounts with low balances cost more to service relative to their revenue. Merchants raise prices to cover interchange fees. Every institution is acting rationally within its own incentive structure. But the cumulative effect of all those rational decisions is a system where the people in the middle pay more for the same life than the people at the top. And most of them never see it because each individual surcharge, the extra $40 on insurance, the extra $15 in fees, the extra half point on the mortgage feels small, manageable, normal. It is normal. That's the problem. The markups are normalized so completely that most people don't even know they're paying them. They compare their spending to other middle-class households and conclude they're doing fine, but they're all paying the same inflated price. The comparison that matters isn't your cost versus your neighbor's cost. It's your cost versus what someone with a 790 credit score and $100,000 in liquid assets pays for the identical product. When you see that gap, when you calculate it line by line, category by category, you stop thinking about the middle class as a stable destination. You start thinking about it as a pricing tier, one that's optimized to extract maximum revenue from people with just enough income to pay, but not enough leverage to push back. The way out is not to earn more. Plenty of people earn $150,000 and still pay the markup because their credit score, their liquidity, and their negotiating habits haven't changed. The way out is to systematically remove yourself from the pricing tier. One credit score point, one renegotiated bill, one raised deductible, one annual payment at a time, until the system starts treating you like someone it has to compete for instead of someone it can quietly overcharge. That's not a dramatic transformation. It's a series of boring, invisible moves that nobody will notice except your bank statement. And over a decade, those moves are worth more than a raise. I'm not a financial advisor, lawyer, therapist, or any other licensed professional. The content on this channel is for educational and entertainment purposes only. Everything shared here reflects my personal opinions and should not be taken as financial, investment, legal, medical, or relationship advice. Any stories, examples, or characters used are composite illustrations meant to explain ideas, not to represent real people or specific situations. Real-life outcomes vary widely because everyone's circumstances are different, and any statistics referenced may come from studies with limitations and may not apply to every individual. Always do your own research and consider your full situation before making important decisions. When needed, consult a qualified professional who understands your personal circumstances.